Okay, good afternoon, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president. We get the good fortune of hosting many distinguished people, many very smart people, many very eloquent and engaging people, and many people who are doing some good in the world. We are extremely fortunate that we occasionally get to have people who do to combine 2, 3, or 4 of those traits. Today is a particular bonus. We are having our dear colleague Arvind Subramanian, who, of course, is Chief Economic Advisor to the Government of India, but as I hope everyone knows, is also on leave from the Peterson Institute as our Dennis Weatherstone Senior Fellow, on leave for public service, as we put it on the website. And he truly is a public servant, and he truly does do all 4 of those things. He's distinguished, he's doing good, he's eloquent and engaging, and he's wicked smart, as we used to say in Boston. We are hoping that his literally millions of fans in India and around the world are watching on the web or will catch this on tape or on the web, on our website. Just to remind you, Dr. Subramanian was appointed by the finance minister as Chief Economic Advisor to the Government of India in October 2014. It is, I think, fair to say that perhaps there's never been a more influential economic advisor, nor one as grounded in substance. Many of us, I will admit, had not read the equivalent of the economic report of the president, the economic survey from the Indian CEA in past years. Under Arvin's leadership, it has become a must-read. It is, like our colleague Jason Furman did at the White House here, it is an incredible combination of genuinely applied research, innovative thinking, and a real picture of what is going on in the Indian economy. Arvind, I noticed this on his Twitter feed, that book, the survey, Economic Survey of India, is now replacing the basic economics textbooks at Mumbai University. Sorry, Olivier, fewer sales for you. But it's quite an accomplishment, and we've passed out today a very nice profile of Arvind from India's Business Standard, titled Meet Arvind Subramanian, Chief Economic Advisor and a Professor at Heart. I think the fact that he has done so much with the publications and the research of his group in the Indian government and is so proud of the university impact speaks to that. But I think you all recognize that Arvind is not an abstract academic. There have been some incredible innovations that the Modi government has undertaken and experimented with in economic affairs in the recent years, and Arvind may not have been the cause of all of them, but his intellectual imprint is on all of them and was the cause of many. And so it is my pleasure to welcome Arvind back to what we think of as his Washington home, and I hope he does, the Peterson Institute. Dr. Subramanian, please.
Good afternoon, everyone. It's such a pleasure to be back here, and I'm pleased to be back for many, many reasons. One of them being, I've always maintained that the most scintillating times I've spent anywhere are the Friday lunches at the Peterson Institute. They're just incandescent with, brilliance, ideas, not to mention friendly and sometimes not so friendly disagreements amongst this wonderful staff. So it's great to be back here. Adam, thank you so much for having me and for that a very kind introduction. I'm also delighted to be back because I do want to get into the juice of some real macroeconomics today, rather than, I often have to do a lot of speaking, which is kind of a little more general variety. And today I'm hoping to get into the kind of nuts and bolts of the macro situation in India. I have to say that although I've been, physically I'm away, I do follow what's happening here, and I'm so impressed with the kind of discussions that have been taking place here. Lots of changes have taken place in the U.S., and the Peterson Institute is at the center of so many debates. So it's just wonderful to follow that debate, which I have privilege to. But now to come back and be a part of this today is just really wonderful. I also want to say, by way of a prefatory remark, that this is actually going to be my first public macroeconomic update of the Indian economy after the economic survey came out. So it's going to have, I do hope I'm going to say something a little bit new and maybe even different from the narrative that's taken hold on the Indian economy. So without further ado, let me just give you a sense of the overview. I'll take you through the macro outlook. I want to highlight some of the key reforms that have taken place under the government over the last 2.5 years, 3 years almost. And of course, nowadays, I can't escape without saying a few words about demonetization, which I will do so. And then I want to, if we have time, talk a little bit about what I think are some of the key challenges facing the Indian economy. I want to start with the macro outlook and spend a little bit of time on this. Essentially now we've moved into a inflation targeting framework in India. And these arrangements have been codified in terms of legislation and agreement between the Ministry of Finance and the RBI. And what you see here is headline inflation, which is the object that is what's targeted by the RBI. And you can see that there was a target for 2017 of 5%. There's a medium-term target to be kind of achieved 2018 and perhaps beyond. And people tend to have missed the fact that we've kind of overshot or undershot that medium-term target of next year, and we've been below that for about 7 months, 6-7 months. Now headline inflation is about 3.8%, I think. It's always fashionable to be anxious about inflation, and I think when this is presented, people say, but core inflation, underlying inflation pressures are very high, and it turns out that if you look at what we call true core inflation, which is you strip out food and fuel and transport services, which basically move with oil prices, you find that the red line, in fact, even true core has been heading towards, has been declining for now a long time, about 8-9 months, and is also headed towards the medium-term target. So not only is what is targeted well below the objective, but also underlying pressures, I think, are easing considerably. And if you look at the outlook, for example, I think contrary to, perception that's gained hold that, maybe the inflation outlook is a bit worrisome, my own view is that it's actually relatively benign. First, because, the exchange rate, the nominal effective exchange rate has appreciated significantly, which is going to put downward pressure on inflation going forward. It's about an appreciation of about 4 to 5%. And the anxiety that all emerging markets have about Fed actions and US policy in general, I think now it's fair to say that there is less anxiety about capital flowing out of emerging markets. And so the need to factor that into account in domestic policy, I think is a little less unnerving in some ways. And in India, the monsoon is always crucial for both the inflation and the activity outlook. And the Indian official bureau has just come out saying that the monsoon is likely to be normal. So that so my own view is that the external outlook, the inflation outlook, is actually quite benign. Headline well below the target of 12 months later, underlying core inflation easing, and the outlook also relatively benign. I mean, of course, this also means that the government and the central bank have done a good job of keeping inflation under control. Now, I just showed. So on the activity side, I think that I am a little bit more, worried about that, because if you look at this is value-added growth, core value-added growth. If you strip out agriculture and government services, it's actually been slowing quite a bit. Headline gross value-added is about 6.5%. GDP growth is about 7%. But if you strip out some of these kind of exogenous things, you find that activity is slowing to some extent. One of the indicators of this, I mean, kind of manifestations of this slowing activity, is that real credit growth to industry is at a kind of growth is at an all-time low. So it's like real credit growth to industry is minus 10%. And this is kind of, I'm going to talk a little bit about why that is the case. We have what's called this twin balance sheet problem, I think still very much placing a dampener on investment in India. But you can see that this is down. It's also the case that, the index of a kind of manufacturing index that we track, it's been growing at about a volume index. Basically, it's flat. No growth in the manufacturing index. Now, having said credit growth decline has been sharp, what has happened to some extent is that non-bank financing of the corporate sector has picked up to some extent. We have a lot more corporate bond issuance now in India, so that's making up for some part of it. But underlying financing to credit to industry is down considerably. I think the one bright spot in the Indian economy is that suddenly reflecting what's happening in the recovery in the world economy for the last few quarters, non-oil export volume growth after languishing in negative territory for a long time, for about 6 or 2 to 3 quarters has started rising, and I think this is perhaps what is the one really bright spot about the Indian economy. You come to the Peterson Institute and you have to talk about exchange rates, and in this case, the exchange rate developments in India are quite worrying. We have, the rupee has appreciated relative to the dollar, to the yuan by about 10 to 12%. And the red line you see on the right is the official real effective exchange rate. But I have, in the economic survey, I've constructed just, changing the weights to give more weight to Asia because we do compete now more and more with countries like Vietnam, Indonesia, Philippines, Bangladesh, especially in the manufacturing sector. And if you do that, you do see that, India has lost competitiveness quite a bit since actually the government took over. It's about 12 to 15% loss in competitiveness, and recently it's strengthened quite a bit. How has policy responded? I think that this fiscal consolidation has continued apace. The central government fiscal deficit has come down steadily by about 1 percentage point over the last 3 years. You see that's the red line. It's again down by about 0.2, 0.25. So essentially what the government has done at the center is to adopt a policy of just steady fiscal consolidation. We've just had a report submitted by an expert committee on what should be the fiscal policy framework. I was a member of that, and I have I have a dissent note to the main committee report. which I would urge all of you to read, and both the dissent note and the rejoinder to it. Essentially, that the committee, in fact, recommended a very sharp consolidation this year to go from 3.5 to 3%. The dissent note that I wrote had a more gradual glide path for consolidation, and the government, I think, preferred the gradual glide path to the very sharp and abrupt consolidation so far. But so on the one hand, the government, I think, its credentials of being, fiscally prudent are borne out by policy actions. The question is, the way I'd like to put it is that, is the government being extraordinarily responsible or not? And I put extraordinarily in quotation marks. I mean, that's the kind of question that arises if you just look at the outlook, the fact that inflation is under control. And it turns out that public investment actually, after having increased 2 years at the general government level this year, is also going to come down. So, so in that sense, I think government is to some extent going to be a drag on growth going forward. Similarly, monetary policy, this is the real rate, the real repo rate, policy rate, which is, the red line is based on headline inflation, and also, increasing steadily. So if you look at it, fiscal policy is extraordinarily responsible. Monetary policy is extraordinarily responsible. And the real effective exchange rate is appreciating very strongly. So to me, therefore, the growth outlook is that while the economy is recovering, I think that exports I can see providing some impetus. Policy is perhaps not providing the impetus that may be necessary. So I forecast a kind of steady, gentle recovery from the what's happened after demonetization, and not the kind of robust recovery that is creating anxieties, even relating to output gaps closing very quickly and inflationary pressures building up. So that's broadly. So to cut a long story short, inflation under control, activity slowing, and but a core activity slowing, but the recovery happening at a gentle, steady pace rather than at a very torrid pace, with not a whole lot of support from policy. Now turning to reforms, I think that if I were to kind of highlight a few major reforms that have happened under this government, I think the big difference with what preceded the current government's tenure, there was this sense that especially in the auctioning of public assets, land, coal, spectrum, it was seen as very, very, underhanded, and there's a lot of corruption. I think now there's much more transparency in the auctioning of public assets. So the credibility that the government has acquired by seeming to be, by being much more transparent in dealing with public assets, and therefore, reduced levels of high-level corruption, I think is a big plus that the government has achieved. Also, a number of legislative things have happened, especially there's a bankruptcy code that's been passed. The institutional arrangements with the RBI have been codified. And really, and there are other legislative actions as well, which I think have really been very solid and supporting the reform effort. I think if the two major achievements, I would say, of this government really have been to build upon this architecture, bringing together financial inclusion, biometric identification, and mobile. We call that JAM because J in Hindi stands for financial accounts, A stands for Aadhaar, the biometric identification, and the mobile. And really, this architecture is really being strengthened considerably to improve the delivery of government services. For example, we have probably the world's largest cash transfer program, which is the cooking gas subsidy in India, which is it's actually bigger than Bolsa Familia. The estimates that we did are that at full implementation, it probably results in a saving of about 20% just by eliminating ghost beneficiaries, deduplicating, all the benefits that you get from having this biometric identification. Of course, and I think the mother of all reforms, and something I had the good fortune to be associated with, is the goods and services tax. And here, for all those India watchers, I want to stress two things about the GST. One, of course, is that it's the most ambitious tax reform. I mean, it's something that is simply inconceivable in the United States. It's just simply inconceivable. Not just because it's a value-added tax, which people here on the left and right hate, but also because it's actually a tax that has to be coordinated between the center and the state. So now, instead of the center levying indirect taxes, the states levying a multiplicity of taxes on the movement of goods between states, all this is going to be eliminated and is going to have one uniform rate of taxes. And I think the benefits are going to be quite substantial. Firstly, creating a common market in India by eliminating barriers between states. I think also the big benefit is kind of the compliance benefits that I envisage will happen. I mean, this is the kind of mind-boggling number that kind of turns me on, which is that when it's fully implemented, every month, the IT backbone here is going to be matching 3 billion invoices. What I say I've bought from Jeremy and what Jeremy says he sold to me, that's going to be automatically matched by the IT system. And so, so once people know that, I think the prospects for voluntary compliance also will increase tremendously. So I think the goods and services, that's one aspect of the GST. But for me, I think as exciting the aspect about the GST is that it is truly a ambitious and bold experiment in what I call an innovation in what I call the governance of cooperative federalism in India. Because now every issue relating to indirect taxes, everything, exemption limit going up by 2 rupees, tobacco at 10 rupees or 15 rupees, everything, procedure has to be done cooperatively between the center and the states. So this mechanism is called the GST Council, and I've sat in on these meetings for the last 6-7 months. So you have the Union Finance Minister and 29 state finance ministers. I mean, maybe the European Union, you're kind of used to all of this happening, but now it's going to happen in India as well, that everything has to be decided cooperatively. And I think that's really, so far, it's, I think, worked quite well. So it's something that's really really, I think, very bold and kind of big bang reform has been the GST. Now, this is the point at which I think I should talk a little bit about demonetization. Let me make 3 propositions about demonetization in kind of increasing order of humility as both an economist and as someone who pretends to do political economy as well. I think proposition number 1, which is what we said in the economic survey, is that there were, I think, short-term costs because of demonetization. These costs were largely felt by the informal sector, the cash-intensive parts of the economy. And by definition, because many of these things were in the informal sector, we will never have a good macro estimate of these short-term costs. That's almost the nature of the beast. I think luckily those costs, I think, are now well behind us because it related to essentially a shortage of cash, and now that cash has kind of come back. The economy has been remonetized, and so there should be no lingering costs from that. I forgot to say that, I just, if I'm repeating myself, my apologies. Essentially what happened was that on November 8th, 86% of the currency in circulation, the two highest denomination notes, ceased to be kind of legal tender. And we estimate that, if you do the arithmetic correctly with all the assumptions about what was liquid, what was not liquid, in the survey we calculate that in that quarter, cash declined by something like 20%, and for the year as a whole, cash cash growth is going to decline from about 17% to 1%. So it's a pretty big, cash shock. The one thing for aficionados of money and stuff, I think the most fascinating things which I kind of learned as I went along is that it's been a very unusual monetary shock, because on the one hand, cash declined enormously, but it was intrinsic to that cash came back as deposits back into the banking system. So a broader aggregate of money, as it were, didn't decline by as much. So there are all these kind of salivating possibilities about, for research in terms of the substitutability between cash and other forms of money that I think are really worth exploring, because it's fascinating. And I'll give you one example of that in just a second. So it's been a very unusual kind of random experiment in monetary economics and about different forms of money and what they mean and what they don't, what matters, what doesn't matter, how substitutable they are. So that's point number one. So short-term costs behind us because there was a lack of cash. Now the cash has come back. Point number two is that, while I think the overall costs we're still waiting to see the data in terms of the impact on the formal sector GDP. It's going to, the data will come in 2-3 months' time, so we'll get a better handle, and maybe the actual impact will be a little bit greater than what the headline numbers are indicating, but that we'll have to wait and see. But I think I've been really, really surprised by how attenuated the impact has been, even relative to what I expected and even relative to what you would think, given the numbers that I just said. If cash declines from 20% to 1%, you think it's a huge monetary shock, but that hasn't been borne out. And I don't know why that's the case. I'll give you one or two tentative explanations. You take agriculture, for example. This happened in the middle of the sowing season, so there's a shortage of cash. And a lot of agricultural operations are pretty cash intensive. You have to pay labor with cash. You buy your inputs with cash. But it turned out that the planting in agriculture was, not just not affected, it boomed. I mean, it was completely unaffected by demonetization. So the question is why and what was going on. And now there are some preliminary surveys that have been done. But essentially, 2-3 things might have happened. One, there was much more, the informal credit arrangements were extended, were increased. That's one possibility. In agriculture, people substituted self-employed labor for formal labor, and there was a surge in the use of plastic and digital as a result of this. So a number of these things, but they're not at all watertight explanations, but in fact, the fact that the impacts were much more attenuated is something that was has been quite revealing to me, at least. And the proposition number 3, I would say, of course, is that it has where it's humbled me the most is in my understanding of political economy. I think the analogy I have is it's kind of the what's wrong with Kansas argument here, that why do Trump voters, supporters are the ones who are, most open to repealing Obamacare. Something of that is kind of going on here with a vengeance. And, Robert Solow once famously said that, all these discussions in economics begin with great rigor and end in a blaze of amateur sociology. I'm going to do some amateur, armchair psychologizing. But essentially, I think that, people have, been willing to, take part or actively sacrifice for what they thought was a much greater good, which is the greater good that the corrupt and the people who had the black money were actually being gone after. And so they were happy to participate this, even though they felt the cost. If you were in India, but in November and December, everyone you met would come to you and tell you the story about how he was standing in line to collect cash because there were limits on how much you could get. And everyone would say, I spoke to someone in the line and that person said that, yes, it's hurting me, but it's hurting someone else much more. And, those are the rich guys, those are the corrupt guys. And so I'm willing to kind of pay for that. But, I think this is going to be a fascinating area of political economy going forward. But I think it has been quite surprising in terms of what happened with demonetization. Now, last few slides before I shut up. On the challenges, I think the major macroeconomic challenge now is the fact that we have a corporate sector that's really over indebted, and correspondingly the banking system, especially the public sector banks, are pretty weak. Two numbers on the corporate side. I mean, let me be careful and say that most of it is kind of a legacy problem. It's a consequence of the rah-rah years of the 2000s when there was a lot of exuberance about Indian growth and infrastructure investment took off. But the numbers that I think bring home what the situation is today, 40% of corporate debt is with firms who are not able to earn enough to repay interest. The interest coverage ratio is less than 1. 40% of firms. Stressed assets as a share of loan portfolio for the public sector banks. Some private sector estimates are that it's close to 20%. Now, let me just make a small comparison with China. I'm not an expert on China, but I think that one way to think about India and China, because China has a similar twin balance sheet problem, I think perhaps there are two differences between India and China. One, the numbers are much bigger in China. When I last read the IMF, report on this, Chinese private sector debt to GDP is something like 160 to 170%. Is that broadly about 170%? The Indian thing is about 55, 56%. So in that sense, I think the Indian situation is not large enough to create serious financial kind of distress or panic. Because if you think about, if you work through the numbers, in the worst case scenario, with 2 to 3% extra recapitalization, you at least solve the problem. So in that sense, the magnitude, what it is taking a toll of is investment. Private investment growth has been negative. Private growth has been negative for several quarters now, and you saw the credit growth numbers. So it's more like a slow bleed than a kind of financial panic situation. So that's, I think, one bit. The government is grappling with this very seriously. There are lots of discussions on how to deal with this, but I think at the heart of the difficulty is very simple. How does a political system in which concerns about cronyism, crony capitalism are so strong, how does that system, how is it able to forgive, is the public sector taxpayer on the hook and forgive private sector debts? I think that's the heart of the political problem, and we're still kind of grappling with how to do that. I think the second proximate challenge recently emerging is fiscal. I spoke about the center consolidating, but now the center and the states are pretty much almost 50-50. The thing I'm using here is that the center is Penelope during the day, stitching, and the states are Penelope at night, unraveling what's stitched during the day, and a little bit of that is going on. So the worry is that fiscal consolidated center could be undermined by what's happening at the state. And of course, we've had a spate of announcements recently about agricultural loans being waived off. These could cost, if it were to spread, these could cost something like 2% of GDP, add to the deficit if there is a kind of if this thing spreads as is possible. So I think that's a kind of a big challenge. Now, Adam, do I have 2 more minutes, or shall I stop? Oh, 3 more minutes. Okay, you're very generous, Ad. So I want to talk about, now I want to go from the kind of macro and the cyclical to really the 40,000 big picture. This is, my favorite chapter in the economic survey, chapter 2. I'd like all of you to read it. Martin Wolf wrote a column on this chapter. I think that if you step back and ask me what are really the meta challenges facing the Indian economy, I think that and this is nothing to do with any one government, nothing to do with, it is, I think, part of the broader Indian ecosphere. One, there's extensive and inefficient redistribution, largely in the form of subsidies, but much more. And we're still kind of it's not proving easy to dismantle it. I mean, we're chipping away at it via this Aadhaar business, but that's addressing more, the wastage and the duplication. It's not getting to the problem of, consumers facing market prices that we're not able to, whether it's fertilizer, food, subsidy, water, power, all subsidized. One of the, I guess this is please take it in the right spirit. I mean, rarely, it would in any economy would fertilizer be a macro issue, and that's one of the charms of the Indian economy, that the fertilizer sector is, in fact, because the fertilizer subsidy is almost 1% of GDP. So, you need to understand the fertilizer sector to understand redistribution in India. The second, I think, meta challenge, which I think is really is this ambivalence about the private sector more broadly. I think one of the areas where much more progress has not been as rapid as it should is in the strategic disinvestment program, not just of this government, but for all governments. Very few governments have been able to do this. So in a sense, my one-liner on the Indian economy here, which is my throwaway line, if you want to summarize what's happened over the last 45, 50 years, basically that India has gone from socialism with limited entry to capitalism without exit. I mean, that's kind of, one way of capturing the Indian economy. Exit is very difficult, and that's true about the public sector as well. And the way we've shrunk, basically, we've shrunk the public sector basically, to use that horrible American word, grow, by growing the private sector. We've grown the private sector through entry, and that's the way we've shrunk. But we've not actually frontally addressed this public sector problem. I guess finally, the India-China comparison always comes up. And I think if there's one thing that, why is India not as rich as China? The ability of the Chinese state to deliver infrastructure, health, and education, just these 3 things, is just extraordinary. And India is just lagging considerably behind on that. To me, the puzzle here is the following, and I'll end with this kind of very, very deep political economy puzzle, which I don't understand in India. On the one hand, we say the state hasn't delivered all these things, especially health and education. But the puzzle is, why is it that over 50, 60, 70 years, democratic politics has not created a political opportunity in actually doing this? I mean, if millions and tens of millions of children are uneducated or not very healthy, there is clearly a political opportunity here. Politicians should be able to say, look, vote for me because I have transformed health and education. But that somehow doesn't seem to have happened. And it's, for me, a deep puzzle, especially given that people know that the private returns to education now are very high. So the private value of education is high, and despite that, we have not seen corresponding commensurate pressure on the state. So I'll just end with this anecdote. In the last election, the recent election in Uttar Pradesh, 200 million people, world's 5th largest country, we just had an election there. And in the run-up to the election, the incumbent, obviously a really, really smart politician, if you followed the campaign, every day, all the newspapers blanketed with, his pitch, basically. I built a highway from New Delhi to Agra. Kind of, I've been so efficient, I've built this highway, why don't you vote for me? And so the question was, why couldn't he have said, or why didn't he think of saying, or why didn't he do and say, I educated, tens of millions of children, vote for me on that, but he said, I built the road, so vote for me. Anyway, so that I think is where we are at a kind of 50,000 feet level. Sorry for, taking up too much time. And thank you, Adam. Thanks for everyone for listening. Happy to take questions.
So thank you, Arvind, for figuratively but not literally dropping the mic. These are expensive. It wouldn't be you, and it wouldn't have the same effect. I dropped the mic. It wouldn't be you, and it wouldn't have the same influence if it didn't have the 45,000-foot meta thinking. And I'm not quite brave enough to do that. So before we open it up to public questions, I'm going to ask you just a couple more straight-up macro things. So India is coasting along with very little credit growth or even credit shrinkage. Somehow survived demonetization. I agree, we don't really know what happened. Let's leave that.
As I say, sorry to interrupt, I would say demonetization is so yesterday,
That's a great way to avoid questions. Very low inflation. So is the Bank of India right to keep such a low inflation target? I mean, thankfully, India's not looking at a zero lower bound problem like the rich countries. But, we used to think it was okay to have a little more inflation than that, a little more credit growth than that. Do you think the RBI is maybe missing a trick here? Or, talk about the regime if you don't want to talk about specific decisions.
Adam, you realize you're going to get me into trouble for for answering that question. But see, the inflation target is 4 plus or minus 2. So I think it kind of passes the Olivier Blanchard kind of test, maybe not, But I think that I just think that what has happened, it's more something that's happened around the world. I think that this narrative that you're not seen to be credible or responsible unless you're kind of always fearing that inflation is around the corner. And because in this case, of course, it's not so much a question of the target. It's just that where we are, even relative to that target, that we've been overperforming, undershooting the target, and credit goes to them for having achieved this. But the question is that what does it mean for policy going forward? And I think especially when the economy is soft, both fiscal and monetary policy, could they be doing more, is the question that I'd like to pose.
Thank you. One other question. You mentioned the obligatory exchange rates issue, but let me take it a slightly different way. Depending on which 7 people get appointed to the Fed in the next 12 months, most of us are expecting a Fed tightening cycle. And last time we had the taper tantrum, India was hit, a number of major emerging markets were hit. India, rightly and thankfully, did not get repeatedly hit the way some more deserving countries did. But how do you feel about the tightening cycle this time through, both for India and for other major emerging markets? Is it all priced in? We don't need to worry about it? Are you worried about strange capital flows?
Yeah, I think a lot of it has been priced in, one. Second, I worry less this time around, at least for India, for 2 reasons. I think that all the macro fundamentals are, when it happened last time, our inflation was, oil prices were very high, inflation was double-digit, a fiscal deficit getting out of control, and our reserves, we didn't have as much reserves. But I also worry less about India is because our corporate sector then had a lot of foreign currency denominated borrowing. This time around, it's kind of much less. So the whole, interest rates go up, capital flows out, exchange rates come down, and you have these balance sheet effects. That, I think, India is relatively a better cushioned against. But as far as other emerging markets concerned, I just follow what the IMF, and they're always saying, lots of foreign currency denominated in other emerging markets. But India, I think, is relatively well cushioned on that.
Last question, just following up. Is there anything the government you serve did the government you serve did to encourage that deleveraging of foreign debt by businesses, or was it just they got smart after the last go-round?
I think that that's a really good question, Adam. I think what happened was that given after the global financial crisis, right, when growth slowed down and you have all these over-indebtedness, so the desire for firms to borrow to finance investment also came down. So on the one hand, the government kept the borrowing limits reasonably tight, but on the other hand, they never really felt the pressure because firms were just not in a position to invest and therefore to want to borrow to invest. So both these factors kept this in check.
Thank you very much. Let me open it up. We have a great group of people here who came to hear Dr. Subramanian. These are on the record questions. Please identify yourself and try to pretend you're asking a question if you are. We have a roving mic in front and a standing mic at back. Jessica, could you go to the front here, please?
Thank you. Susan Lund from the McKinsey Global Institute. Two questions on labor markets. Here in the US and in Europe, there's a lot of concern about automation, robots, artificial intelligence, and the future of employment, whether there will be structurally higher unemployment. On the other hand, we have new ways of working through independent work, freelancing, the gig economy. So one question is that a concern in India? And the second is you've got a very low female participation rate in the labor force. So what's your outlook for female participation?
Thank you.
What's the outlook for
Female labor force participation.
So on female labor force participation, it's one of those very important subjects which I don't get involved in too much. But I think that within India there is a kind of a debate and serious pushback against even the diagnostic, as it were, that female labor force participation is low and declining. In fact, I read a paper yesterday which I think challenged the view that female labor force participation is low because lots of activities that women do don't get counted in the survey. But this is kind of statistical kind of quibbling. But the broader point, I think, is a good one. I think the way the government has been trying to deal with this is to address the kind of the gender thing broadly. Not just in terms of the female labor force participation, and the Prime Minister, for example, is very keen that women's safety, all these things, all of the things that contribute to getting women into the labor force, providing hostels, safety, and so on. Now, the interesting thing, what's happening is that in some sectors, firms are actually relocating. For example, in the clothing sector, firms are relocating to places where they can be close to female labor. So that's a kind of interesting trend that's happening, which could address some of these issues. But I think this is a little bit above my pay grade because I don't deal with this subject very closely. On the first point, I think that it's frightening everyone. I think the World Bank recently did a study which showed that even in the textile and clothing sector, robotics could kind of displace tens of millions of jobs. I mean, the notion that now a robot can cut soft cloth, for example, which you would think was very labor intensive. I mean, that's a pretty frightening thought. So it's something that we're worrying about quite seriously. But with employment, I'll be honest with you, it's easy to diagnose the problem. It's much more difficult to know what exact levers to pull to kind of address this on a macro level. I mean, apart from the usual, get the growth up, get investment growing. give incentives to some labor-intensive sectors, which we've done. I think we've done a lot for the clothing sector. We want to do a lot more for the footwear sector, which is also part of it has to be also, for example, negotiating agreements with countries where there are high barriers to exports of these labor-intensive goods. For example, the European Union has pretty high tariffs on clothing and footwear, and that's something that's affecting us. So we are trying to be active on that score as well.
Thank you. At the back mic, please.
Hi, Jack Caporal with Inside U.S. Trade. Obviously, I have a question about trade, and in your remarks, you mentioned that the export growth India has seen as a bright spot. It's an impetus for growth overall. I was wondering if you could maybe expand on those comments in the context of India's trade relationship with the U.S., general trends that you see, and also if the government is in India, views some of the more America First rhetoric that's come out of the U.S., some of the reviews of U.S. trade deficits, which the U.S. has with India, at least in goods and overall, whether or not that's something that's on the government's radar in terms of broader economic planning.
I think that anything that is going to interfere with our export growth, creates anxiety. And in the context of the United States, we're all watching very carefully the H-1B situation, the visa situation, because I think that's both in symbolism and substance. I think it could be quite important. At the moment, all of you know this better than I do. Maybe the rhetoric has been ahead of the actual action on the visa side. I don't know, but as long as we can keep this thing manageable, it should be okay. But if there are serious actions taken, it's something that's going to kind of worry us a lot. Because remember that our exports of services are about 40 to 45% of total exports. So and about I think something like 50 to 60% of all our exports of services goes to the United States. So it would worry us quite a bit.
Great, thank you. Over here, please.
So, Arvind, I just wanted to pick up on the question that was posed earlier about robotics and automation.
Sorry, did you identify yourself?
Forgive me, I'm sorry. Krishna Guha, Evercore Partners. I wanted to just pick up on the question that had been asked earlier about robotics and automation. To look in the more macro sense, there is this concern, as you know, that India may have missed the boat in terms of the opportunity to develop for a period through labor-intensive manufacturing. To what extent do you subscribe to that? And if there is at least some diminished opportunity to leverage that growth model going forward, where will the future of employment and productivity gains lie in the new model that India may have to chart for itself?
As I say that, India kind of missed the manufacturing, low-skill manufacturing boat, decades ago. And now I think the Prime Minister's Make in India program is kind of an attempt to, I think, reclaim at least kind of part of it. And to some extent, there is an opportunity, even though it might be slightly diminished. There is an opportunity created by the fact that, Chinese wages are rising and the fact that, many of those labor-intensive sectors are moving out. It's just that they're not coming to India as much as they've gone, say, to Vietnam and Bangladesh and even Ethiopia. So that's, I think, where we're trying to focus our attention. Can we attract some of this, displaced manufacturing? But to the extent that it doesn't happen, I think we are going to rely a lot on services for our growth going forward. I think the way I think about it is that, look, we missed the manufacturing boat long ago, but what we need to do on services is to make sure that, we don't reach the Lewis turning point in services for another 25, 30 years. China's Lewis turning point, it turned after about 25, 30 years of manufacturing. Can we do the same thing in services? And that means, just increasing the supply of, medium-skilled labor, the IT sector, across the board. I think that's what we need to do. It worries me a little bit that even there, for example, the Philippines attracts the call centers that we used to do 10 and 15 years ago. So, but I think that's, the challenge. But the productivity gains there are huge. I mean, wages are still really very low in India. So the scope for, my own optimistic view on India is that, we are still only, 10% of the frontier in terms of standards of living and wages. So we have this convergence catch-up play to do for another 20 years easily. As long as we don't do anything seriously wrong, there's major scope there. Manufacturing, but perhaps much more in services.
Thank you. Another question? So here, please, lady in the pink jacket.
Thank you. Thank you. Marie Diron from Moody's. I was interested in your point on the twin challenge, the balance sheet, corporates and banks. And how do you see, what would it take to resolve that? It is a complex challenge that a lot of economies are facing too.
I think there are lots of proposals that have been made in India, and the deputy governor of the RBI, a month ago made a speech talking about whether we could have a bad bank kind of solution. In the economic survey also, we've proposed a kind of bad bank type thing. So clearly something of that nature has to happen, either via bad bank or by empowering the public sector banks to kind of take actions to write off these loans. I think that's the problem. Remember, public sector banks are public sector officials. They're subject to all these rules. And they're very, very cautious because they feel if they write off these loans to the private sector, these investigative institutions will come after them. So that's the heart of the problem. So the question is whether do you empower the banks, as they are, or do you kind of centralize everything by creating a bad bank, centralize everything, confer some authority on that, and that's where the discussions are at the moment. So which way we come out, let's see what happens.
We have time for one more question.
Caroline had a question, yeah.
Oh, please.
Carolyn Freund, Peterson Institute. I had a question about GST. So I think it's being implemented in this coming summer. And how is the government preparing for it in terms of, is it expected to affect prices and any reaction to it, and whether you can give any advice to the U.S. as we try to undergo our own tax reform?
Yeah. So on the price impact, Caroline, I think that the explicit aim of the new structure of taxes is that it has to be revenue neutral relative to the past. So in that sense, it's being designed and the rates are being set in a way that the average level of taxes will not go up. In fact, I've been arguing very strongly that because of all these compliance benefits that will come in, I think we should kind of err on the side of setting, having lower rates rather than higher rates, so that will also, any concerns about inflation. And I don't worry about the inflation also because, the logic of the new rate structure is going to be that you don't want new rates to be certainly higher than existing rates, and so you want to keep it that way. So that's why you don't want to. I think in terms of, I think there are going to be challenges, but the preparations have been going on for years. This has been a tax that's kind of 10 years, 15 years in the making. And so that kind of segues into the last question. It takes a lot of political preparation, a lot, apart from all the technical work, which will probably be easier here. It needs a lot of political preparation. I think it's a miracle how we forged this political consensus in India to get this GST, because it's like 30 sovereign entities basically giving up their sovereignty to levy taxes on indirect taxes. And so the correct way to think about this, and our European friends have this lovely term about pooling sovereignty, not giving up sovereignty, and that's, I guess, what it really is. But it's can you imagine, 30 different, sovereign entities saying, yeah, we'll give up our powers and, we'll do it collectively. It's, in this era of, when everyone is getting cynical about cooperation, I think this is a great example of, a counter example of good cooperation.
Can I ask you one last question, picking up on your eternal optimism and belief in cooperation? So we have another former chief economic advisor, German Zendelmeyer, is with us now from Germany. I've mentioned Jason Furman. Without any disrespect to my dear friends who currently and formerly in those jobs, the ability of you to come in and make a difference, for at least from the outside, is extraordinary. And you've done it mostly by doing good economics. Perhaps reflecting imperial mindsets and other horrible mentalities, I had thought it would be a little more difficult to do that in Delhi than it would be in Washington. But you have made a difference, and now it's looking quite difficult to have good economics make a difference in Washington. What guidance or inspirational words can you give us for how to be 1/10 as effective as you?
Look, I think, Adam, you're being far too generous on the one hand and far too pessimistic about things here as well. I loved, this is a totally, I loved the last line of Martin Wolf's last column. I know, there is, the world doesn't end in 4 years. There's there is life, beyond. I think there's a famous Hegel line, the owl of Minerva flies only at dusk, so I think, things, are bound to look up, I think. So I'm optimistic.
Cool. Thank you, Arvind. As always, you joked about India as moving from socialism without entry to capitalism without exit. For India's sake, we're not looking for you to exit anytime soon, but you always have free entry here. Okay. So we'll look forward to having you back.